Business combination is covered under Ind AS 103. It is a transaction in which the acquirer obtains control of acquiree. Here there are two main points which has to be noted. One is they should have the control and the other one is the acquiree should be a business. So let's see the definition of control and business. Control is defined under Ind AS 110. As per that, an acquirer has a control when they have a right for variable returns with their involvement in the investee and when they have the ability to affect those returns through the power that they have. So one thing is they should have the right to variable returns and the second point is that they should have the power to affect those returns. Business is defined under Ind AS 103. There are three main elements to form a business. One is input, secondly process, and finally output. So, when a process is applied on the input, it gives rise to an output. Examples of input can be like non-current assets, employees. Processes can be like management process, any operational process, resource management process. A very important thing to note is that admin, finance and all are not processes. Output includes the goods or the services which are delivered to the customers or when the business generates investment income or any other income from the activities. An important point to note is that whenever there is a process and input, it can be considered as a business even without the output. But such processes should be a substantive process. In such cases, it is important to check if that input and the process is critical to produce the output. That is, it is not just the asset acquisition. If it is so, then you'll have to check whether it includes the workforce and other inputs. If that is also true, then it is a substantial process and it can be considered as business combination. Ind AS 103 will be applicable. Now, if the input and the process is critical to produce output, but there is no employees or no other inputs available, then it is not a substantial process and it will come under asset acquisition. If the input and the process is not very critical to produce an output, then it is not substantial process and once again it is only an asset acquisition. Let's try to understand this with the help of an example. An entity acquires an equipment and a patent in exchange for 1000 crores cash and land. The fair value of the land is 400 crore and its carrying value is 100 crore. Fair value of the equipment and patent are estimated to be around 500 crore and 1000 crores respectively. The equipment and patent relate to a product that has been recently commercialized. The market for this product is still developing. How should this be accounted for? Is this just an asset acquisition or does this constitute a business and is it a business combination to be recorded under Ind AS 103? Let's find it out. This example clearly tells us that there is an input and the process for the business, but the output, which is the product, it is recently commercialized. So there is no actual output yet in the market. It is still developing. So here the consideration that is paid is mainly for that input, which is equipment and the patent, and hence this is an asset acquisition and it cannot be considered as a business combination. We can easily identify whether it is a business or an asset acquisition with the help of the concentration test. As per the concentration test, if the fair value of the gross assets is concentrated in the fair value of single identifiable asset or similar identifiable assets, then the concentration test is said to be met and it is an asset acquisition and not business combination. So in our example, the equipment and patent which totals to 1500 crores and the consideration paid is around 1400 crores. So this consideration is concentrated on the assets which is 1500 crores. Therefore, this is an asset acquisition and not business combination. When performing the concentration test, few points have to be noted. First is when we are determining the fair value of gross assets. This includes the consideration paid for acquiring the business, the fair value of any non-controlling interest, fair value of any previously held interest in that acquiring business, and finally the fair value of liabilities. It should exclude cash and cash equivalents, deferred tax assets if there is any goodwill related to deferred tax liabilities. Second point to note is single identifiable asset and similar identifiable asset. Single identifiable asset is like land and building. Land and building is considered to be one, whereas similar identifiable assets, it will depend upon the nature and risk associated with that asset. So when the value of 1, which is fair value of gross assets, is concentrated on the value of 2, which is single identifiable assets or similar identifiable asset, then the test is said to be met and it is an asset acquisition. So overall, business combination should have input, processes and output. If it is just input and process, then there should be a substantive process. In such cases, Ind AS 103 is applicable. Otherwise, the next group is acquisition of group of assets where it is assets and not the business, and it is identified separately. The consideration paid is individually allocated to the assets. In brief, business combination, first thing is to check whether there is control of another business. When there is control, the second thing to check is whether it is a business. In order to check whether it is a business, concentration test can be used, and accordingly, if it is met, it becomes an asset acquisition. If it is not met, it is a business combination. So if company A acquires company B, which is running, it has all the inputs, raw materials, it's a manufacturing unit and it is producing an output, and as a whole, company A acquires company B, then I have a control over company B that I can get variable returns from it, and I can make the decisions to get the variable returns. In such cases, company A will apply Ind AS 103 at the acquisition date. If company B is in such a situation that the business is down and there is no actual output, but they have their missions and they want to sell it, and as a company, company A is going to buy those assets, then it is only asset acquisition and not a business. It cannot be shown as investment in subsidiary. I don't have any control since it is not a business, it is only an asset. I have control over the assets but not the business. So this will be recorded just as assets in my books. Let's take another example. Company A is a pharmaceutical company. Since inception, the company has been conducting in-house research and development activities through its skilled workforce, and it has recently obtained the intellectual property rights in the form of patents over drugs. The company has a production plant that has recently obtained the regulatory approval. However, the company has not earned any revenue so far, and it does not have any customer contracts for sale of goods. Company B acquires this company A. Determine whether company A constitute a business in accordance with Ind AS 103. Now, if there is a slight modification to this question, wherein consider company A had the revenue contracts and a sales force. In such company, the company B invests and it acquires all the inputs and processes except their sales force. In such cases, whether the definition of business is met in accordance with Ind AS 103, let's see. So in our first question, we have the input and the process, that is the skilled workforce, the plant, production plant, intellectual property rights, and as processes we have the strategic and operational processes. Even if there is no output or revenue generated, it will still be called as a business because there is an input and the process is substantive. Considering that definition, it will constitute a business. In our second case, where company A had sales force and generated revenue, but the company B acquired company A without the sales force. We have to see whether the sales force can be easily replicated. If sales force can be easily replicated, then company B has acquired a business. Or if there is a case wherein company B is also into the same business, then they can use that to generate the output. They can use the sales force of company B to generate the output. Hence, that will also be called as a business.